10 grand off of the price, it's not going to save you a lot of money over time. It's going to save you anywhere from 30 to 50 bucks a month on your payment. That same $10,000 can get you a lower rate that'll save you about $250 a month.
Whenever I buy real estate, I like receiving a spreadsheet with different options. Let's say I offered $800,000 for a property, no buy down. How much would my payment total be?
Conventionally, you can get a 3% max on your closing costs from the seller. FHA is 6 and VA, I believe, is 5.
Essentially, if you got a 6% credit, you can use that for some of your closing costs, and you can use that to buy down the rate if you wanted to buy down the rate.
6% on $800,000, that's a pretty big credit. Their time frame is one of the most important things to consider when it comes to buying and financing a home. So often that just gets ignored and lost in the shuffle. Nobody keeps their loan for 30 years. You have to be able to figure out, okay, am I going to...
In today's real estate market, sellers are often facing a big question, and buyers are facing the same question. When it comes to structuring the deal, does it make more sense for me to get a lower price, or does it make more sense for me to get a credit to maybe permanently buy down the interest rate, hence receiving a lower monthly payment? So in today's episode, we're going to be talking about structuring the deals, price reduction versus interest rate buy down. How much does it cost? How much does it work? What are the limits as to how much you can receive in a credit? And then we're going to be giving you real life examples as to how much you would save if you got it for less money versus how much you would save if you use that in terms of a lender credit to buy down the rate. To help us with that, we have a repeat guest. His name is Jason Hall with Hallmark Financial. Welcome back. Yay.
Thank you. Appreciate it.
I'll ask it very just direct. Is it better to reduce the price of a home or if you're a buyer, get it for $10,000 less? Or is it better to use the $10,000 to be able to buy down the rate? Which one saves more in terms of a monthly payment? Or does it vary as well too, just depending on what the financial markets are doing?
That's a really good question. And as like we were talking about, this is actually a subject I just broached on my socials here this week, this very thing. And 10 grand off of the price, while that sounds great, it's not going to save you a lot of money over time. It's going to save you anywhere from 30 to 50 bucks a month on your payment. And so if you're focusing on payment, that same $10,000 can get you a lower rate that'll save you about $250 a month. So, or maybe $290, depending on where you're at. So if you're looking at it that way, it's not going to take a long time for you to save that 10 grand that you would have paid more for the home. So like, let's just say it saves you, just to make it easy, $200 a month less in your payment, in a year. You're at what, for 2,400, so let's say 2,500 a year. So, in 4 years, you've surpassed that savings that you would have gotten in the price, and then it's all gravy at that point. Not to mention what you've saved out of your pocket that you maybe could have used to help in some other situation in your life financially.
Just because you're getting a credit, that doesn't mean, or buying down the rate, that doesn't mean that you have to buy it permanently. The seller can actually potentially buy down the rate instead of giving you a discount on the price. Is that correct?
You could use any combination of seller concessions to help cover closing costs or permanently buy down your rate or whatever you need to do, which ends up netting you out in a better position than if you would have just gotten a lower price on the home.
So here's something that I like to do whenever I buy real estate. I like receiving a spreadsheet with different options. What I mean by that, let's say I offered $800,000 for a property, no buy down. How much would my payment total be? Let's say I offered $800,000, but I asked it for a $10,000 credit. How much could I buy down with that, and what would the payment be? And what would the savings be from the $800,000 with no credit to the $800,000 with 10 credit? And then how long would it take based on the savings to recoup the $10,000 as well too, to be able to compare? And if you can do that for different scenarios, you'll be able to say, yes, this benefits, or no, this doesn't benefit me. Now, you were telling me something off camera that this calculation is not a calculation that every single time works, meaning that it doesn't always make sense to buy down the rate, right? At least I understood something like that off camera.
I mean, it really depends on the amount. So, like, if somebody's and I guess it depends on if it's, numbers are apples to apples, but if the price reduction is significantly larger, like if someone's like, hey, I'll give you a $50,000 price reduction, but 10 grand to buy down your rate. Okay, then maybe it doesn't make sense. Maybe at that point you might want to take the reduction, because there's a limit on what the seller can offer you in terms of concessions, but there's not a limit in terms of what they can offer you in terms of price reduction. Yeah. So, that's where a good agent comes into play, like you, somebody who can maybe negotiate a little reduction in the price and negotiate some concessions to help reduce that payment monthly. But obviously, the larger the price reduction, the more benefit there is in terms of long-term benefit to the buyer.
But in some cases, if it's a $10,000 reduction or a $10,000 credit to buy down the rate, this is where you have to do the numbers. In some cases, the $10,000 credit to buy down the rate may be more of a savings on a monthly payment than the $10,000 price reduction, basically. Now, you mentioned that there's limits as to how much you can receive in terms of closing costs from the seller. What are those limits, and what do they depend on in each scenario?
Conventionally, you can get a 3% max on your closing costs from the seller. FHA is 6 and VA, I believe, is 5.
So essentially, if you got a 6% credit, you can use that for some of your closing costs, and you can use that to buy down the rate if you wanted to buy down the rate, basically.
Correct. Yeah. I mean, 6% on $800,000. I mean, that's a pretty big credit. You'd have to use it to cover all the costs and buy down and a bunch of stuff, because there's no way there's going to be enough costs for that. But if you have, there's just you'd have to get creative with how to use all that at the end of the day. The other thing on VA you can do, if it's a veteran, maybe a first-time use, maybe they don't have anything, you can use it to buy out their funding fee as well.
And then here's the thing, and this is where deal structure comes into play, and this is why it's important to have somebody seasoned like Jason or somebody seasoned like ourselves, is like if you have a $48,000, it may not, if you have a 6% credit, it may not benefit you to take all 6% for closing costs, because the rate buy down may have a diminishing return where at a certain point, you get the max return, and after a certain point, the return's not there. It's like maybe like $50 less for a $10,000 cost versus $10,000, $250 less for a $10,000 cost. So this is where you have to be able to analyze and be like, well, maybe instead of a 6% credit, which is $48,000, I'll take a $23,000 price reduction, and I'll take $25,000 towards my closing costs, which now they gave you the optimal return in both cases, basically.
Right. Yeah. You have to run kind of the numbers on that to determine where that kind of sweet spot is, if you have a seller who's really willing to offer that much. It's not super common, but it does happen.
And I think it just depends on how much activity they have on the property, how many offers they have on the property. If there isn't much activity or there isn't much offer, there's an opportunity to potentially get creative with how you structure the deal, as long as it makes sense for both parties, basically. For permanent buy downs, is this something that's common right now in today's marketplace? Are buyers and sellers doing permanent buy downs, or are they just not doing that at the present moment?
Larger amounts isn't really common. Like, every rate kind of has a little bit of a cost or a little bit of a credit that goes back to the buyer. And so sometimes you'll have a sweet spot where, like we were saying, hey, 6.5 may not cost anything, but sometimes 6 1/8 costs less than 6 1/4. And so while there is a little bit of a difference in the cost, sometimes it's to your advantage to buy down the rate a little bit, because there's kind of an inversion in the pricing on those rates.
So a lot of it depends on the pricing. Now, what's the difference between like a 2-1 buy down and a permanent buy down?
So a 2-1 buy down is a temporary buy down, where if, let's say, your rate is 6.5, if you do a 2-1 buy down, that means the first year you are 2% under that rate, and the second you are 1% under that rate. So you're at 4.5% for your payment basis on the first year, and 5.5% for your payment basis on the second year, then it goes to 6.5 and stays there for the life of the loan for the last 28 years.
With new construction, some of the builders actually offer, like I've heard, that they buy down the rate for the entire community basically. And hence they're able to, in some cases, to offer, like, instead of a 6% market rate, even like a 4.5% or 5%. Have you ever heard of something like this?
Yeah, so I was actually the preferred lender for Fieldstone Homes for a number of years in Utah, and they had all kinds of different incentives that they offered. But the thing that happens nowadays is a lot of these builders, especially the larger builders, they own their own mortgage company. And so there's kind of that relationship where it's all under the same roof. And so what the builders end up doing is they end up pricing those incentives into the home already. And then it allows the mortgage side to be able to offer below market incentives because they're charging you extra for the property on the real estate side. So yeah, it happens. It happens a lot now. It's kind of frustrating for us on the mortgage side because there's not a whole lot that we can do to combat that. Because if the buyer's like, hey, I don't want to work with ABC Builders Mortgage Company, I want to work with Jason, they just lose out on those incentives, and the cost for that's already built into the price. So it's not like they're getting a lower price. Some builders are a little more flexible with some of those things, and some just aren't.
And it's interesting because even on our side, when we're selling a property that's maybe 2 years old in the same community and you've got a brand new construction and you're having to compete against the builder where the builder's offering a 4% rate versus buyers getting a 6% rate over here, then it makes that competition. Now, here's one thing that I learned, Jason, and maybe you can relate or kind of share a little bit of insight. Like, I think when you're considering buying permanently down the rate or taking a price reduction, a lot of it depends on market expectations and what are your personal goals. So like, let's say that you plan on selling the property in 2 to 3 years. It may not make sense for you to pay down the interest rate because you may not receive the true value of that if your goal is shorter term. Let's say that you expect rates to drop in the next year or two. It may not make sense to do a permanent buy down. You may be better off just taking the principal reduction because at that point, so some of it plays into effect. What are your personal goals and also what are your expectations of the marketplace, aside from the numbers on whether or not it makes sense to buy a permanent buy down or even a temporary buy down. Would you agree with that?
Yeah, I always tell people that their time frame is one of the most important things to consider when it comes to buying and financing a home. So often that just gets ignored and lost in the shuffle. But especially with our military buyers, if you're here and you're thinking, we're probably going to get orders in 3 years, you have to plan and finance accordingly based on that expectation. Everybody always thinks they're going to keep their loan for 30 years and everybody always does not. It never happens. Nobody keeps their loan for 30 years. So you have to be able to figure out, okay, am I going to keep this same situation for 3 years, 5 years, 7 years? Where are my kids at in terms of where they're at in school? All of those things are extremely important when it comes to mortgage planning. And that's something that I think, like you said, it's just really important that it's a discussion point when you're talking about how you're going to finance your home.
Now, how does the pricing vary on loan to loan? Does it vary the pricing for buy downs if it's FHA, VA, or conventional, or is it all pretty standardized?
The buy down basically is the cost of the difference between the payments. So it's going to be different for, say, VA, FHA to conventional because FHA loans are typically lower rates. And, they're lower rates because there's an upfront mortgage insurance premium. And so they end up compensating you a little bit by having lower pricing. So, if you're at a 6.5% rate on a conventional loan, it's probably 6% on FHA. And so therefore the buy down is going to cost a little bit less in terms of raw numbers.
So in other words, work with somebody that you trust and run different scenarios based on different situations as to how to structure the deal. And Jason can do that for you. Jason can help run different scenarios for you as to what makes the most sense from a lender and a numbers perspective, and also factoring in what some of the goals maybe are, for example, job relocations and some of those other things.
Yeah, I just think buyers need to understand that it's not only is it okay, but it's really important that they're active in the input in the planning of how they finance the home. They shouldn't just show up and have somebody tell them, okay, you're getting this loan and this type and this way and that. No, it's important that your mortgage advisor helps advise you in what your options are, what you can choose, and the benefits of the different choices, so that you can make an informed financial choice.
Amazing. Now, Jason, if somebody wanted to get in touch with you, what's the best way to do that?
You can always go to my website, which is hallmarkfi.com. You can also shoot me an email at jason@hallmarkfi.com. You can call me 801-209-1534, or you can look for Hallmark Financial on the socials, Instagram, Twitter, places like that, if you want to reach out there as well.
So in today's episode, we had Jason Hall with Hallmark Financial. We talked about permanent buy downs. We talked about whether it makes more sense to get a price reduction on a property or buy the interest rate down. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode would help somebody, make sure to hit that share button. Thank you so much, Jason. And to our viewers, until next time.
Thank you.